We have both Brian Ladd and we have Jay Lyons for you this morning with the next presentation. So Brian Ladd is principal broker at Cascade Sotheby's International Realty and owner of the Ladd Group, which sells over $100 million annually in Bend. He's a fourth-generation real estate expert and has been selling, investing in, and developing real estate for 20 years. And next is Jay Lyons. He's the president and also the principal broker at Compass Commercial, and since joining in 2011, Jay has sold and leased over $287 million worth of properties. He's responsible for leading operations and working with companies, shareholders, and all aspects of business development and strategy. And their presentation today will be back-to-back, and it's about Central Oregon's real estate 2020 analysis, as well as a 2021 outlook.
Well, thanks for having me today. I'm really excited to be part of this, and it's events like these, especially in trying times here in Bend, that makes it such a great place to do business and to live. So I'm going to strictly talk about residential real estate today. Not only when I'm talking about COVID and economic indicators, I'm going to be talking about them strictly within the terms of real estate. Not that I'm tone deaf to the implications of the health effects and whatnot of this pandemic, but I want to talk about strictly how it affects us here in residential real estate here in Central Oregon. So to talk about real estate this year without talking about COVID simply doesn't make sense. It's really kind of pre-COVID and post-COVID. And the first chart that I pulled up here talks about where we were prior to COVID. So here in April of 2020 shows that we were in for a fairly strong year here in real estate. Our average housing price was up about 11%. We were at about $545,000 for an average sales price, and inventory was down. We were at about 4.3 months. Not abnormally low, but a little lower than the 6-month inventory that we usually like to see in real estate, and that was down about 20% year over year. Both points showed that we were in for a pretty normal year in real estate. But then COVID happened, and what I've often said is that not only was COVID a great disruptor to our economy and our industry, it was also the great accelerator. And I really think it's on all of us in residential real estate here in Bend, Oregon, to understand that we're in a post-COVID world. I have a phrase that snow melts from the edges I like to use. You know, it's a little by little until it's gone. And we've noticed some dramatic changes to the demographics, the work habits, and the housing needs here in Central Oregon. And I think that the future for Bend has shifted in a big way this year, and we need to talk about it. So the impact of COVID was most noticeable for me here in unemployment. If we look at this chart, this is the weekly unemployment numbers for the state of Oregon. All through the year, we are averaging about 4,000 to 5,000 claims per week, which is higher than we would want it to be. But then it had a spike up to 70,000 unemployment claims in 1 week in April of 2020. That was 14 times our average, and it brought up our unemployment rate to about 15%. So that was very obvious, obviously. And then the next was what happened to real estate sales. Pending sales went down 37%, and that was a downward trend in a season that usually sees an increase in sales. So the word on the street, what were we hearing? It's 2008 all over again. I had real estate agents telling me that they didn't feel comfortable representing their buyers, that they weren't comfortable with the market. There was words that housing was going to crash, or the phrase was, I'm going to wait until housing prices come down. So then, what was the reality after April? Let's get to the next slide here. So sorry about that. But the really data didn't support the pessimism that we saw in the streets. This chart that I just pulled up goes all the way back into the 1980s. And what this shows is this is the Case-Shiller Index for housing prices. And what it shows is there's not necessarily a direct correlation between housing prices and the overall economy, or even recessions for that matter. It's interesting for a lot of people to know that housing actually went up. Housing prices went up in 3 of the last 5 recessions. It just so happens to be that in 2008, the one where housing and the economy were so tightly correlated, that's fresh in our memory, and it's natural for us to have this gut reaction that if we're going into tough economic times, that housing should correct, right? But one of the other big things that we saw was migration trends. Here's a few headlines from San Francisco and Seattle. We saw it across the nation. We could pick any big city, whether it be LA or New York. The consistent trend was that housing prices went down in those urban cores, rental prices went down, vacancies went up, and everyone was moving to these lifestyle secondary markets such as Bend. And we were in the absolute crosshairs of that migration pattern. So what did we also see in unemployment? So unemployment also came down strongly. We're back down to about 4,400 a week, which is still too high. We're at 8% unemployment. We know there's a lot of people struggling out there. But once again, strictly in the terms of housing, that showed strength in the recovery, and it showed in housing. So housing prices jumped, housing sales jumped. So here we stand now, sales are up 89% year over year, and sales prices up 17% year over year. We're now over that $600,000 price for the average price of a home in Bend, Oregon. Inventory was the next one. Here, let me try to get to that. And we basically sold through all available inventory. Inventory absolutely plummeted, 60% down year over year. And we currently stand at 2.4 months of inventory. And that's really a moving average, and it's actually lower than that today. And a side note, for the homes that are actually selling, the average days on market is 5. So we're essentially out of inventory to sell here in Bend, Oregon. And I know that there's a lot of people out there that'll say, but hey, great, we've spiked, but it's a bubble now, right? So let's talk about that a little bit, because I think it's, it behooves us to get deep into the data and not necessarily follow that first emotional reaction we may have to some of these trends, especially when they're so dramatic. If we look at the Housing Affordability Index, this one's from the National Association of Realtors, and we went back to the early 90s on this one. It actually shows that in real terms, the monthly payment of housing is actually fairly affordable right now. We still have a pretty big delta between household income and housing prices, but these interest rates on the right chart show why the housing affordability is not as bad as it may seem, because we're at these historically low interest rates. So this has really helped offset some of these price increases that we've seen that has kept housing prices reasonable. And also, virtually all economists in the nation right now related to housing are predicting appreciation for 2021. NAR's at about 5%, Zillow's at about 7%, and most of the other people are somewhere about between 3 and 6% for the year. Now, the one thing that, a lot of the people, especially who have their ear to the ground, may say is, haha, but I hear there's a foreclosure wave coming. And I don't want to digress too far into the weeds on that, because we can talk about this in the panel, especially with First Interstate Bank. But through the CARES Act in April, May, there was actually something that was built into there that allowed people to have a forbearance on their loan. If they were affected by the pandemic with, through health reasons or economic or job, they were allowed to defer their payments on their mortgage for 180 days. And then if they had trouble even with that, they could defer another 180 days. And there's a lot of economists that'll go out there and look and say, hey, look, at one point we had 10% of all the mortgages this year in the United States in forbearance. There's a foreclosure wave coming. I tend to look at this a little bit differently. And what we've seen is that when we got to the end of that first forbearance program, actually those rates started falling precipitously because, well, there's a couple of reasons. One, there's a lot more workout options than there were in the past. And two, people have equity in their home. So this is very unlike the early 2000s where people had very little equity in their home. Housing prices were going sideways or starting to go down, and they were in forbearance issues, or they were in foreclosure issues. Right now, 3/4 of Americans, 77%, have more than 20% equity in their home. So there's a lot more options. If someone has 10 or 20% equity in their home, they're not going to throw the keys back to the bank if they're in trouble. Usually there's a workout option, and usually the worst case scenario is they sell the home, pay off the mortgage, and pocket the remainder of the equity. So we're in a pretty good spot there. Ivy Zellman, who's an absolute, she's an all-star in this industry in the housing forecasting, her quote this year is, the likelihood of us having a foreclosure crisis again is about 0%. So I'm not as binary with that of absolute or not, but I do agree with her sentiment and that we're in a very different world. So as far as I'm concerned, the foreclosure crisis is not something that I'm actually looking at for the near future. Now, this may get a little wonky. I have the tendency to get deep into the graphs, and I'll try to avoid that. But I find, Mark Twain once said, history doesn't repeat itself, but it often rhymes. So I like to look back into history and look at what happened and try to get clues for where we stand today. So the blue line here that we've got on the graph is housing prices in Bend since 2002 to now, showing obviously the big correction that we saw in 2009, 10, and 11. And what was interesting for me to find is that there were some leading indicators that kind of gave us a heads up that we should have seen in that time that housing was struggling. And those are not leading indicators that we're seeing in any sort of fashion right now. The two primary leading indicators that I was able to dig out of the data were pending sales and inventory. And what was interesting is that our peak pricing in Bend in the previous peak was April of 2007, but yet we started to see some very strong indications of growing inventory about a year before that, and actually about 2 years before the house prices started to go down precipitously, and the pending sales actually peaked about 11 months before that as well. So those data points were there, we just weren't noticing. Now this second graph, this is where it really gets wonky, where I overlaid those three data sets, and we still have that blue line in there that shows the the sales price, but the top one, the blue and the red one, that actually shows the pending sales, and you can look on there and see that that started to chug along and show some struggles about a year before it actually showed up in housing prices. And then the same with inventory. It started to, there was a clear trend that month over month, less people were buying homes. There was more homes available for market. They were on the market for longer. And that started to build about a year or so before we had our last correction. So if we look at the far right of that and try to say, where do we stand today? It's a little different because the factors of where we stand today are very different. We have a housing shortage like nothing we've ever seen before. We have low vacancy in the rental market. We have low interest rates. But if I had to draw any sort of parallel, the data set that I see now and that delta between inventory and sales price and pending sales is more akin to 2002 data, 2003 data, than those scary years of 2006 and 7. And to close this, and I actually just put up a picture here of my son, because we like climbing up the hills as much as we like skiing down them. But as we look ahead to the challenges and the mountains that we have ahead of us here in Bend, Oregon, I think we need to keep our eye out for a decrease in pending sales and a rising surplus in inventory. I think that would be a good indicator for us to watch out for. We have an absolutely unprecedented housing shortage here in Central Oregon, and that's really worthy of a whole subject and conference of its own. Some of the most recent data I was looking at from the Deschutes Housing Authority showed that in the next 10 years, we need about 15,000 homes for median income households between 80 and 120% of median household income. And the current stat that I looked at was that we are at about 700 homes a year, which shows a delta or a shortage of about 1,200 homes a year, even to keep pace with the current housing needs. And that doesn't even take into account all the new families moving to Oregon. So I think that this housing shortage is critical and could impact a lot of different parts of the economy. I also think that these high housing prices are going to create some turnover and barriers. Turnover in the fact that I think there will be a segment of the population that has been waiting to cash out, look for a quieter town, and I think we will see some of that turnover in town, unfortunately. And then also the barriers that I'm talking about are also barriers for people to enter the housing, to buy their first house or to move up that price ladder where they're going from an apartment to a townhome to a single family. And I also think that barrier is going to hurt some of our local businesses as they grow in the years to come, where they're having trouble hiring people because they can't find affordable housing. So as a community and as business owners, we need to look hard in the mirror and say, what investments can we do? How can we get involved to help some of the planning? And not just the planning. I think a lot of the planning is very solid. It's also the investments in the infrastructure to make housing available for all. Another point that I want to talk about is this remote trend, this remote working trend. I don't think it's likely to slow down. I do think it's likely to slow down, but I don't think it's going to end. I was just looking at an Ernst & Young report that was talking about working habits in the years to come. And one stat that jumped out at me was that 3/4 of businesses are planning on implementing remote working as a primary, employment type in 2021, 2022, and 2023. So I think the major rush of the people fleeing the cities to live in beautiful towns like Bend, Oregon, and Central Oregon are here. But I don't think it's a trend that's going to die overnight. Despite having COVID vaccines and as we get some clarity there, I still think that trend is going to be here. And then I also think that a significant interest rate rise, and this is where I really like to speak with some of our other panelists here in a minute, could impact housing affordability. And I think that's one of the things that could actually tap the brakes of this housing market more than anything else. And then finally, I think that household income versus sales price of a house is a delta that's far too big in our economy or in our beautiful town. But anyways, there's a lot of great things to talk about, and I can't wait to discuss it more in depth with our panel here. And thank you again for taking time to learn a little bit more about what's happening in Central Oregon, and hopefully you can give us some feedback so we can have a really productive discussion about that.
I'm here today to talk about the current state of the commercial real estate market here in Bend and Central Oregon. But before launching into what everyone I think is here to hear about COVID-19, I think it's important to talk about where the market was leading up to COVID to set the groundwork of how COVID is going to impact the market as a whole. And I think where we were previously is going to have a substantial impact. So I wanted to talk about a perception around town that you hear fairly frequently, that there's all sorts of new commercial development taking place around town. And the fact of the matter is that leading up to COVID or leading up to today is not entirely accurate. So if you take a look at this first slide of the Bend office, I'm here today to talk about the current state of the commercial real estate market here in Bend and Central Oregon. But before launching into what everyone I think is here to hear about COVID-19, I think it's important to talk about where the market was leading up to COVID to set the groundwork of how COVID is going to impact the market as a whole. And I think where we were previously is going to have a substantial impact. So I wanted to talk about a perception around town that you hear fairly frequently, that there's all sorts of new commercial development taking place around town. And the fact of the matter is that leading up to COVID or leading up to today is not entirely accurate. So if you take a look at this first slide of the Bend office market growth, this slide shows you the amount of total square footage that Compass Commercial has tracked in their quarterly survey going back to 2001. And it shows you from 2001 to 2010 that the market, or the total square footage of the market, grew by over 1 million square feet, or roughly 78% between that time frame. Now, if you compare that to 2010, which was coming out of the recession, to 2019, the market grew approximately 9.75%, or roughly 232,000 square feet. So that's a sizable decrease in terms of the amount of new office product that was built. Now, on these graphs, you may be wondering why there's kind of a dip in the square footage. Well, if a building is occupied by tenants and then it is bought by an owner-user, that building comes off the survey. So we only track properties that are occupied by tenants or have the possibility of being available for lease at some point in the future. So a building like Lanza, for example, on the north end of town off of Empire Avenue, that primary facility of theirs is owner-occupied, so that would not show up on our survey. So that's a quick snapshot to show you the amount of growth we've experienced in the last 10 years on the market side, and the same holds true for the other properties types that we track. So the Bend Industrial market growth, again, from 2001 to 2010, we experienced roughly 1.7 million square feet of total growth, or 74% of that market. Comparatively, over the last 10 years, that market grew just a little under 500,000 square feet, or roughly 12.42%. If you move on to the Redmond Industrial market, again, you see considerable growth leading up to 2010. Grew roughly 297% or 970,000 square feet. And over the last 10 years, that growth was compacted to about 173,000 square feet or roughly 11.84%. For retail, we haven't tracked it quite as long as we have the other three property types, but going back to 2010, again, you can see the growth has been relatively modest, 177,000 square feet of growth, or roughly 4.9% of the total market. And I think it's important to understand why that growth may have been limited. Well, coming out of the recession, obviously, Bend was beaten down pretty hard the last downturn. Back in 2010, 2011, vacancy rates were hovering north of 20%, and that certainly isn't the time to commence brand new speculative development or construction. So it took time for that square footage to kind of be absorbed, the market to kind of reshape itself and basically bounce back from the Great Recession. Then after that took place, developers were still, skittish in terms of, breaking ground on new development, even though vacancy rates were coming down. Again, not knowing what the future held. They took some serious lumps during the downturn. A lot of property owners gave their properties back to the bank. So again, there was kind of this lag of developers not wanting to kind of stick their neck out, so to speak, and commence new speculative development. So then you get to 2014, 2015, now developers are starting to be a little more comfortable with the market. The vacancy rates have started to drop or compress, and you start to see a little bit of construction. But with that, you start to see land prices start to increase fairly substantially. What we see, or the reason why we've seen such little growth over the last 10 years is because it's somewhat of a perfect storm. You've got rent growth that hasn't been sufficient enough to justify brand new construction. You've got land prices that are expensive and somewhat artificially inflated because of the urban growth boundary and the way our state land use laws work. And then you've got construction costs where a lot of the subcontractors left town during the Great Recession and never came back. And that contractor base has been significantly reduced, and it's driven up the cost of construction to the point where it makes speculative development very difficult. And because of that, we've seen very little growth across those three property types. So that begs the question, well then, if the perception is that there is a lot of construction going on, well then what's getting built? Multifamily apartments. Housing is obviously critical in Bend. There's a lot of people moving to town, approximately 9 people per day, and they need a place to live. And coming out of the recession, a lot of the undeveloped or unfinished subdivisions got bought up, got built, those houses got built. And then shortly after that, developers started showing up on the scene looking to build new multifamily product. And we've seen a lot of it. There's 482 units built in the last 2 years alone, 813 units under construction currently, and a little over 1,400 units that are in the pipeline, although those are just speculative projects and not all of those will be built. So that speaks to the amount of volume that we've seen in terms of multifamily construction. We've seen a lot of hospitality construction as well. So you think about some of these lots that were vacant coming out of the downturn in the old Mill District. Well, now 3 of them have hotels on them. The Residence Inn property, the My Place Hotel property, and the Spring Hill Suites, all in the old Mill District. The Best Western across the street from the Athletic Club of Bend is a relatively new hotel, and there's 2 under construction in Bend as well, the Element and the Home 2 Suites, and that's just Bend alone. There's another hotel under construction by the airport in Redmond as well. So that's been a big boom for the local construction industry as well, and obviously being fueled by the tourism industry here in town that continues to grow and grow. And then owner-user facilities. Like I said, we don't track those on our quarterly survey, but Lonza just went through a big expansion. MBSE EF just built a new facility in Northwest Crossing, and those are just two examples. But we've seen local companies grow and determine they have a need for new space as their company grows, and they've gone through with some construction expansion plans. So that is kind of the bulk of what you have seen in terms of construction here in Bend. I mean, we've also seen public projects, new schools being built, new fire station. But from a speculative commercial standpoint or industrial standpoint, the lack of growth has been relatively modest. And I think that's important to note because it's a simple kind of supply and demand function. When COVID hit, we saw kind of tenants pump the brakes in terms of what they're looking for in terms of new space, or maybe they were looking for additional space and now they're not so sure. But we didn't see a ton of new speculative development leading up to COVID, which could have potentially led to increased vacancy rates or a substantial amount of speculative kind of vacant space hitting the market. And I think that bodes well for us in the foreseeable future because of the modest development that we have seen. So COVID and the impacts that it has had on the market, it absolutely has had an impact. Here are the vacancy rates going back from fourth quarter 2019 until today. You can see the most significant impact is in the office market. That is because most office users, as we're well aware, can send their employees home and say, hey, you need to work from home from the foreseeable future, or if you're more comfortable working from home, by all means do so. Whereas retail and industrial users, they need their brick and mortar space in order to operate their business. Retailers may have an online presence where they can supplement some of their business, but for the most part, if you're a downtown Bend retailer, you need people kind of walking through your door. And if you're an industrial manufacturer who's making widgets, you need your warehouse space or your manufacturing space in order to make those widgets. You can't send people home. So on the office side of things, we've absolutely seen office tenants that may have been looking to expand or have leases coming due say, hey, you know what, I don't need as much space as I had, or you know what, I'm not going to expand into that space that I was thinking I wanted to take on. And I think that's going to be a trend for the foreseeable future. I think some of these companies are going to reimagine how they need to utilize office space, whether it's a timeshare program or a hoteling system where people can come and go. But I expect office to be kind of in limbo for a little while. Whereas industrial and retail, as you can see, have held somewhat steady. The slight uptick that you see in the first quarter of 2020 for industrial was the result of a large block of space at the former Bend Bulletin building coming online, roughly 50,000 square feet. But for the most part, these vacancy rates hovering in the 3.5% are still at historic lows. And that's a very tight market. And if you are a tenant in the market today looking for space in industrial or retail, you're going to have a hard time finding exactly what you're looking for. Whereas office, there is a little bit of a softening, and you may have better luck finding a space, but still, relatively speaking, 7.5% is still a low vacancy rate. So COVID-19 and the impacts that it's had in Q2 when COVID first hit and we received kind of the shutdown orders from the governor, we experienced a significant wave of tenants asking for rent deferral or rent abatement. What we found was most landlords were very much willing to try and work with the tenants in an effort to keep them afloat. They don't want to risk having the space go vacant and having to find a new tenant. Most of these tenants have been great tenants up until this point, and what is going on in the world is 100% completely outside of their control. And landlords recognize that, and like I said, for the most part, what we've experienced is landlords being willing to work with tenants and try to assist anywhere that they can. But landlords as well have bills to pay, they have mortgages to pay, and they in turn have to turn to their lender and ask for relief or mortgage payment deferrals in some instances. So it's very much a we're all in this together attitude, and we have to continue to work through it with the new government orders that are coming through. We're going to most likely see another wave of requests for rent deferral and abatement with some of these companies or businesses being shut down in the very near future. Just a snapshot, we have approximately 550 tenants in our property management portfolio. Of those, roughly 12% are experiencing hardship and experiencing some sort of protection through the government's orders. So whether or not that's they are late on rent, or they have modified their lease in some way, shape, or form, or they're working with their landlord. But again, relatively speaking, it improved through the summer, but now with cases continuing to spike, we may see a second wave of requests coming our way. And the new workplace requirements are causing a lot of stress on tenants. As you can imagine, just with the social distancing and the sanitizing, and even the office users that are in the office place needing to maintain that amount of distance, their space may not be equipped or set up to accommodate that, so they're needing to make adjustments. So it's all across the board, and it's presenting some challenges for tenants and landlords. On the for sale side of things, it's a little bit of a different story. We're seeing significant demand from buyers, both owner-user buyers looking to occupy their own building for their own business, and investors. I think the investor side of things is being fueled significantly by Bend just being on the map and on the radar, and seeing the amount of people that are flocking to town from some of these larger metropolitan areas, and these investors see that and they say, hey, that's probably a good place to put my money and invest long term. On the owner-user side, it's absolutely being fueled by low interest rates. So some of these tenants are out looking to buy a building for their business and saying, hey, it's going to be cheaper for me to buy this building and pay the mortgage each month than it is pay my current rent payment. So it's a very interesting market at this point, and I think it's a very fluid situation. As we all know, we just went through an election. We've got talk of potential vaccines kind of every day that continues to change or be updated almost hourly. And I think it's hard to predict where the market is headed from here. With the exception of long term, I continue to see Bend being a very popular place, and place that commercial real estate investors are going to continue to focus on. And I think it's going to be an attractive market long term. But where we go in the short term is to be determined in the next few months. And I think we're all in this together, and we need to work through it together. And it's going to present some challenges, but Bend is a resilient community, and I think that we will get through it and come out on the other end better than we went into it. So with that, I will turn it over.